Hey, Jason here. Today's video I'm going to answer the question, is Xerox Holdings, stock a buy? This is an investment analysis for Sam G, who requested this on YouTube. Before I get to that though, I need to let you know you can get this series podcast anywhere in the world for free on all major podcasting platforms, Stitcher, Anchor, SoundCloud, Spotify, iTunes, and more. You can get this as part of the Value Investing in a Car series anywhere in the world for free. Plus, please remember to subscribe and hit the notification bell if you're watching on YouTube, so you're notified every time we release a new video, and release new videos all the time. Also, make sure to stick around to the end of the video, and I'll tell you how you can get access to some free resources to evaluate stocks better and faster as well. Okay, before we get to the actual analysis, again, I apologize for what's coming, but I have to say this preamble because if I don't, people get pissy. These stock analysis videos are for educational purposes only. I do not own stock about any stock I talk positively about, and I do not short stocks ever. So I do not short sell any stocks that I talk negatively about. This is purely for educational purposes, to help you become a better investor faster, to help you spot potential red flags faster, to help you spot potential great things faster, so you can spend more time evaluating great companies. Why should you listen to me? In the first 9 years of my career, I've produced investment returns for the portfolios I manage of 23.55%, which puts me just behind Warren Buffett's, I think, 24.2% in the first 9 years of his career. My returns for the portfolios I manage legitimately make me one of the best stock pickers in the world over the last 9 years. So again, I'm not saying that to brag. I'm saying that to give you context on why you should potentially listen to and learn from me, because I want to help people at this stage of my career. So with all that said, again, I apologize for that, but I have to put it in there. Because every time I forget, I get disgusting comments. So let's get to today's analysis video. Okay, most of the time I evaluate stocks here, I don't know anything about the company. Sometimes I do. Most of the time I don't. This case, frankly, Sam G. This was for Sam G, who requested this. Frankly, I didn't even know Xerox was still around. To be honest, in full transparency, I didn't know they were still around. So this is going to be an interesting look at the company, and I can tell right away they have a huge dividend. That's great. 4.2% dividend. I don't look for anything in particular. Dividends are kind of like icing on the cake to me. I'm not a dividend income / retirement investor. That strategy does work if you stick to it. But I'm looking for more of the Warren Buffett style compounders than just where they have growth potential. They're massively undervalued. They're hugely profitable. They have huge competitive advantages, that kind of stuff. I'm not necessarily looking for straight dividend income. But this 4.2% dividend is fantastic. In the last video I did for Javier L on NEO, another thing I want to note here is the price to sales. Again, I never look at price to sales, but NEO had a price to sales of 30, and I immediately knew from that they were most likely going to be extremely overvalued. Price to sales here at 0.7 is one sign the company might be undervalued. Another, again, I don't put much stock in PE or forward PE, but an 11.5 forward PE is one sign the company may be undervalued, which we'll figure out here shortly. What do they do still? So they still do what they've essentially always done. Except now they are in software as well. Still printing, copying, scanning, large enterprise customers. So they're still pretty much in the same market that they've been in forever, which is, again, frankly surprising to me. Oh, and you can see right off the bat, they had a high watermark of revenue in 2012 at $22.4 billion. The revenue is now down to $7.5 billion. What is that off the top of my head? About 2/3, about 66% destruction of value. That is, or in destruction of revenue, sorry. That is not surprising, again, because I know what used to be their business model. And frankly, I didn't even know they were still around. So that huge revenue drop is scary, frankly. Their operating profit margins have actually gone up in the last decade from 5.3% in 2010 to 12.7% as of the full year 2019, which is, frankly, again, surprising. I look for anything above 10% on a consistent basis. While Xerox doesn't reach that for the full decade, it does in the last couple of years. So again, interesting, surprising, and more. Let's see. Earnings per share, again, up over the decade from 1.72 per share, $1.72 per share in 2010 to $5.8 per share in 2019. Their dividend has gone up a little bit, not as much as frankly I expected, seeing their huge increase in their earnings. So there could be room to improve their earnings. Bought back a bunch of shares. 338 million in 2010 is the number of shares they had, all the way down to 218 million shares in the last 12 months. Typically, you want to see company buy back shares if the stock is undervalued. If it is, it's hugely accretive and pushes the stock up. If it's not, then it can destroy value. But in this case, again, I'm assuming because of their destruction, or their, I guess destruction is fair, in their business model, that this has probably increased share value quite a bit. Book value per share has gone down. Not a huge deal in this case. Frankly, because their business, again, I didn't even know they were around, so I thought it was dead. So that they still have book value of even a fraction of its height is a good thing. Again, I'm assuming this has shot values of the shares down over time because it's a basic proxy for the value of shares. But we will find out that in a little bit. Good free cash flow production still. Positive every year except for 2017. ROIC is pretty good. Again, I look for anything above 10% on a consistent basis. It doesn't reach that for the full decade, but in the last year plus, it has. Free cash flow to sales. This does surpass my threshold for the last decade. I look for anything above 5% on a consistent basis. This, off the top of my head, is probably in the 6 to 8% range per year. And in 2019, this was 14%. Now it's 8.9%. Cash levels, pretty good. Intangibles have gone down. I'm assuming that's because they've been having to impair assets, which I talk a lot about. I think it's in the Cody video, US Steel maybe, where I talk about that. In those videos, you can get access below this for free. I talk about the intricacies of book value and intangibles a lot in those videos. So make sure to check those out if you want more context into that. But that also is likely why book value's gone down as well. Short-term debt, long-term debt. But everything looks okay here, again, surprisingly. Okay, this is not okay. So this is cash conversion cycle. This almost doubled since 2010, from 17 days rounded up to 32 days rounded up in the trailing 12-month period. This essentially means it takes double amount of time for the company to complete this entire cycle, which includes buying inventory from suppliers, selling inventory to customers, and then getting paid on that. And then the cycle repeats. So what this has done is, I can tell here, and again, I go into great detail. I think this is on the Archer Daniels Midland video, where I go into cash conversion cycle in depth. The main reason this has jumped is because it's taking them longer to sell stuff with the day sales outstanding. They have more, it's taking them longer to sell stuff, which is keeping their inventory in place longer. And they've also increased their payables period. So it's taking them longer to sell stuff, which is keeping their inventory in place longer, which is taking them longer to pay their suppliers. This combination of things is not good. Most of this stuff we've talked about with Xerox is either good to really good. This is really bad. What this means is, in a real world sense, is that likely Xerox, again, is having a harder time selling stuff, which means they have to discount it potentially, which leads to lower revenue, which can lead to lower profits and free cash flow. Their profits are actually, I think, up, if I remember right, from their operating profits. Let's go back up. No, their operating profits are down, but their operating profit margin is up. So this, again, not good. Go to the Arches Daniel Midland video for my full explanation of why. Because again, I think that video by itself was 30 minutes long. So check that video out. You can find that video link below this to find out in full context of why this is bad, but this is really bad. Which also affects their balance sheet strength, which we are going to get to next. And let's go to the annual for this. Typically I want to look at the quarterly because I want the most recent info. Let's look at the annual for this, because I can guarantee that their inventories are probably either higher or their accounts receivable are probably lower, just from looking at those past numbers. And yes, their accounts receivable are about $1.2 billion lower than they were in 2015, from $3.75 billion in 2015 to $2.53 billion in 2019. How did I know that? From looking at the cash conversion cycle. From looking at the cash conversion cycle and knowing its intricacies very well. I can already tell from looking at those numbers that either they had an inventory issue where inventory was building up, so they had to discount it, which leads to profit margin issues. Yes, their profits are down, but the profit margins are up, so I didn't think it was an inventory issue. That led me to thinking it's a accounts receivable issue, which in this case it is. Accounts receivable are things like payments that you expect to receive from customers. So these are down by $1.2 billion in the last 5 years. So that's essentially $1.2 billion in expected orders less that the company has now than it did 4 plus years ago. Which, again, I was going to go back up to the quarterly. Let's keep going with this, though. That will typically lower the balance sheet strength. And here, I'm glad I said here. So in 2015, they had $8.8 billion in goodwill. That's been down to 3.8 to 3.9 billion since 2016. And I said earlier that inventory and lower revenue issues would likely lead to impairments. And I can almost guarantee that's what that is. Impairment. Again, this exact process I would go through looking at any company. So there's multiple impairments, it looks like. In 2015, $145 million impairment charge. And what is this? Okay, so that explains some of it, but their impairment went down by like $5 billion, so this doesn't explain fully what happened. Billion. Okay, let's go to this. It's only $90 million. It's $190 million. So where is the $4 to $5 billion? an impairment. Okay, here's a big chunk of it right here. So they impaired a huge chunk, about $4.2 billion of goodwill in fiscal year 2015. So there we go. That's where most of the impairment came from. The whole reason I'm showing you this, again, without you going to the, I'm pretty sure it's the Cody video, US Steel. There's a couple others where I talk about impairment. This destroys the value of the shareholder's equity when a company has to impair assets. When that happens, it lowers the overall value of the underlying value of the company, because the book value, or in this case shareholder's equity, which is the same thing, it's just different terminology, that leads to lower share prices over time. And yes, in this case, their total equity, or again, book value or shareholder's equity, all three of those terms mean the same thing. They're just different terms. I don't know why that is. Their book value is down from $9.5 billion in 2015 to $5.8 billion in 2019. Again, I can almost guarantee, combined with the lower revenue, lower profits, that that's led to a huge loss in value for Xerox over time. And it has tech bubble, huge. Okay, let's go more recent. Where are we at here? So 2012, they peaked 2013, 2014, 2015, and then yes, so since 2015, end of 2014, 2015, their shares are down, what is that? About 35%, which again, actually is a little bit surprising to me. That's less, or that's not more than that, because the revenue's fallen by about 66%. So that's, again, surprisingly good in their favor. But I knew that was all likely because of what I saw here on the balance sheet and what we saw on the other pages. Okay, let's go to the cash flow statement, see if there's anything here. And we could go back and look at the impairments over here, but we've already talked about that, and I've already illustrated that, so I don't really need to here. Debt issuance here to pay off old debt, $1.86 billion in the last 12 months to pay off old debt and to likely raise cash for COVID related stuff. Frankly, not much interesting on their cash flow statement. And with all of that, again, I frankly expected them to be undervalued. They are still overvalued. I don't put much, if you see my other videos, I don't put much stock into price to earnings, price to cash flow, or forward PE. But when I do use them, I look for metrics to be under 20. PE is over that at 28. Price to cash flow is under that at 9. Forward PE is 11.6. The most important number here is EV to EBIT. I like for anything below 8 on this metric. And the reason I like enterprise value more than price is because enterprise value includes things like cash and debt, which since 99% of all companies on earth have cash or debt, I want to know what those are as a total business owner, which is how I think about looking at any investment. And EBIT, I like EBIT, comparing EBIT instead of earnings, because EBIT is operating income, and that's far harder to manipulate than net income. And there's also other reasons, which I'm not going to get into today, that I talk about on the blog post. I look for anything below 8 on this metric. This is double that at 16.5. So with its huge loss in revenue, I'm going to bring you back over here while I'm talking. With its huge loss in revenue, with its lower profits, with its lower cash flows, with its huge impairments leading to lower book value and lower kind of underlying intrinsic value for the company, and it being overvalued, there's no way I'd invest in this right now. Is it a kind of no-brainer, like the stay away, absolutely 100% stay away like Neo that I talked about yesterday? No. But it's still something I wouldn't want to invest in right now if I were to buy new stock. If you own old stock and you're looking for pure dividend income, this might be a good stock. Frankly, I need to do more analysis for that, because if their business is projected to still kind of deteriorate over the long term, which again I would assume it is, but I don't like assuming things when I invest, then this might not be. Sorry, my phone is going nuts right now. It's on vibrate. Then that might not be the best dividend income play either. So I'm not sure. It depends on your personal situation. Sam, for example, if you own this stock, it depends on your personal situation. What I would recommend, but generally, I wouldn't recommend buying new stock for all the reasons: the lower revenue, the likely lower revenue going forward, lower profits, impairments, all the stuff I talked about. If you own old stock, again, that depends on your personal situation, but I would guess that there's probably better dividend income stocks out there. Would be my guess, and frankly, I can think of one off the top of my head is Altria, which I've now talked about in 2 videos. I talked about this in the last video as well, and this one, so I'm probably going to do a video on Altria as well. So I hope this helped. Thanks for the awesome recommendation, Sam G. Again, this wasn't, most of the companies I've covered have either just been terrible and just outright I said no to. There's been very few in the middle that have been kind of on the fence, like Xerox, so I appreciate this. Case study again. If I missed anything, let me know in the comments below. If I didn't explain anything well or something well enough, let me know in the comments below. If you want to check out the other videos I referenced or the other videos in this entire series, I think we're up to 30, 40 videos now where I evaluate stocks. Those are all for free below this in the description. If you're watching on YouTube, make sure to like, love, share, subscribe, comment, and hit the notification bell so you're notified every time we release a new video, and releasing new videos all the time. If you're listening on the podcast, same stuff, but we'd really also appreciate a review, because the more reviews, views, and listens we get to our content, the more people we can help. If you're looking for more information on how to become a better investor faster, make sure to check out our free resources below this. We've got our 5 free gifts guide, which includes the full preliminary analysis checklist that I'm going through right now, that I'm just going through the visual portion. This guide gives you the full version, the full written version, so you can do it yourself. Make sure to also check out our PDF book of How to Value Invest, of my book, How to Value Invest, and copies of our guide, 7 Tips to Picking Great Stocks and 3 Times You Must Sell. You can get all 3 of those for free at the links below this. If you're looking for more personalized help from me, check out the link and the information for our masterclass below this as well. If you want me to evaluate a stock for you, again, yesterday I evaluated NEO for Javier L. Today, Xerox for Sam G. I think we're up to 7 to 10 now that I've evaluated for people. If you want me to evaluate a stock anywhere in the world, put it in the comments below. The only stocks I will not look at are banks, because I don't evaluate them, and insurance companies, because I have to dig into the financials and actually read the financials to figure out if they're a good company or not. Other than that, if you want me to evaluate a stock for you, let me know in the comments below. But until next time, have a great day. Talk soon. Bye.